In today's video, I'm going to show you the unique volatility edge which the Dow provided us with today when the S&P and the Nasdaq failed to. Let's start by reviewing our morning volatility note first, and then we'll move on to charts. Now, the morning volatility note is sent about an hour after the markets open to all of our futures volatility box members, and it gives us a landscape of the 10 major futures markets we look at. Now, if we zoom into just the index markets, all 4 of our index markets today were on their aggressive volatility box models. So if we were to place that on this line graph, all 4 of our index markets would be on the second notch. That's telling us that, hey, scalp opportunities today are a little too risky. We cannot be scalping today. However, the aggressive models are still being respected, and so far it's looking like these are the models to use for the rest of the day. Now, if we come into our Thinkorswim charts, here's what price action looks like with the aggressive volatility box models loaded on. Let me start with the S&P first, and then we'll move on to the Dow so you can spot the difference yourself. Now, starting with the S&P 500, in that 7 to 8 a.m. Pacific hour, we had a sell-off take place. That sell-off took price action all the way into the aggressive volatility box's cyan entry lines. Now, as part of our setup, this is step 1. So we had price action breach our volatility box models. Step 2 is price telling us that, hey, we now are officially in oversold territory, and we're looking at price action to reverse. That's with this green arrow, the edge signals indicator. Now, once that happens, we want to enter at the cyan entry line or better with our stops outside of the volatility box clouds. This distance right here, which is what we risk, is what we're looking for as our first target. So it's a fairly simple setup here. It's what we call our fade setup. Now, in the S&P 500, when price action breached our cyan entry line, we very quickly bounced away, hitting our first target before we even saw an edge signal. In fact, we never even retested that after seeing our edge signal here. So the S&P was a runaway market. We didn't get an opportunity to enter the trade in the zone where we'd like. However, if we contrast this with the Dow, you should notice something different. The Dow, same exact time, 7 to 8 a.m. Pacific, we had price action sell off, and we triggered our volatility box breach. So this is step 1 of our setup. Now, step 2 is we want to see the edge signal. That's this green arrow. And we had that print inside of the Dow, along with opportunities to enter at the cyan entry line. In fact, you had almost 15 minutes to enter for this long side position here. Now, the risk on this particular trade inside of the Dow, remember, stop outside of the clouds, so about 62 points of risk, and we're looking for that same 62 for our first target, which we exceeded, and we went to a max total move of much more than the 62, but we fell short of target 2. We went to about 94 points, but target 2 was closer to 141 points away. So just a T1 inside of the Dow futures, but you can see how this long side entry is different from the one inside of the S&P. Here we actually had an opportunity to enter. Price showed us signs of stabilizing, starting to gather itself, and then reversing compared to the S&P and even the Nasdaq if I show you the Nasdaq. The Nasdaq was essentially a touch and go, very quickly reversing compared to, again, the Dow, where price not only touched, it stabilized, gave you an opportunity to enter before it actually started to go in the direction that we expected. So one more time, here's how that morning volatility translated. All 4 of our major index markets were on the aggressive volatility box models. They ended on the aggressive as well, but in the middle, the Dow is the market which gave us an actual opportunity to enter with the edge on our side. So that's why the Dow stood out to me today, and hopefully you can spot that difference yourself for all futures volatility box members. One other reminder, we released our new dollar cost average calculator. This is included for free for all volatility box members, so be sure to check it out. You can download the final version of the indicator along with follow along the Thinkorswim exercise. This is about a 30-minute long exercise in which we'll code the indicator together, and this is included for free with your membership. So be sure to check that out. I think it's a fun tutorial and one that you'll find valuable, especially if you like to invest longer term. Alright, take care everyone. Good luck trading, and I'll see you in our next update.